All right, let's try an example. We're going to do an example of amortization of a bond discount. So I have this one handy that we did in a previous video. So A was an example of a bond discount. We see here we have a bond discount. So when do we amortize the bond discount? We said we were going to amortize it. We're going to record it each interest period. Now most corporate bonds pay interest twice a year. So unless they say otherwise, assume they have 2 interest periods per year. All right, so our total discount is $24,000. So the straight line method, our formula is total discount. Total discount we said was $24,000. You divide it by the total number of interest periods. Total number of interest periods. There's 2 periods a year. So 2 times, we need to know the life of this bond. And I know this problem didn't communicate that because they weren't really emphasizing that. They just wanted the issuance. So let's say that we were told that the bond life was 6 years. Okay, and again, if the problem wanted us to calculate amortization, they'd have to tell us the life of the bond. Okay, so let's say this one was 6 years, and we paid 2 times per year, so we have a total of 12 interest periods. So we would amortize $2,000 per period. So this is amount to be amortized. Basically, to record it, the account that we're going to use, it'll move to interest expense. Move to interest expense, which is why our definition, we said that the interest, it's going to move to interest expense, and if it's straight line, it'll be the same amount. So now let's go ahead and practice the journal entry. So we know the amortization, how to calculate it with the straight line method. Your formula is to take the total discount or premium, divide by the total number of interest periods. If they give you the interest periods, great. If not, assume it's paid twice a year and multiply it by the number of years, year life of the bond. Okay, that gives you the amount that will be amortized every interest period. So let's look at the journal entry. Since it's getting amortized every interest period, we're going to record amortization each interest payment entry. So if you remember before, our journal entry was interest expense and cash, or interest payable, depending on if we're paying it or not, right? We'll assume here that we are paying it. And we said the formula was PIT. This is to record payment of interest, payment of bond interest to bondholders. So let's say we're making this at June 30th. And again, the problem it would tell you, it would say interest is paid twice a year, June 30th and December 31st, something like that. Okay, so here are the accounts that we know to record payment of bond interest to our bondholders. But now we said we're also going to record amortization. So we're just going to do it in the same entry. Okay, so the offset will be interest expense, but we're also trying to reduce this discount. The goal is to get it to 0. So right now we have a discount in there on the debit side, $24,000. Every 6 months, we're going to decrease it. The goal is to get this to 0. It zeroes out. Where is it going? It's moving to interest expense. But we can't move it there all at once. Why? GAAP's matching principle says that we have to match a portion of the expense over the life. Okay, we can't move it all at once. All right, so if we want to decrease the discount, we're going to credit. So you're going to credit discount on bonds payable. And now I'm going to expand my explanation here because I'm not only recording the payment to my bondholders of interest, and I'm doing another thing, and amortization of bond discount. Okay, start with cash. That's your easiest. Well, I guess this one might be easiest because we already did it. So we can just bring that down. It's on the credit side, 2,000. Do your PIT. Going back to this example, par value was 600,000. Did they give us an interest rate on this one? No, they didn't, because again, that wasn't the purpose of this problem. That's okay. We'll say the contract rate is 10%. Okay, so our par value here was 600,000 times 10%, and we pay every 6 months, so 6/12. So do that math, and I get 30,000. Interest expense is the sum of the two, because we said we're taking that amortization and moving it to interest expense. So a discount is always going to increase interest expense, because if you think about it, what's happening here is we only got cash of 576. We have to repay 600,000. So this is kind of like an extra cost of borrowing the money. Cost of borrowing money is interest expense. So we're eventually going to put this deficit that we have to make up and repay, eventually it's going to go to interest expense over the life of the bond. But we don't call it interest expense here on the date of issuance because that would violate GAAP. We need to match it little by little over the life of the bond, over the 6 years in this case. Okay? Now, because this is straight line, you're going to make the exact same journal entry 6 months later at December 31st. And then another 6 months later, June 30th of the next year. A total of 12 times we're going to make this entry. And interest expense is always going to be the same because that was our definition of straight line amortization, is we're going to allocate the same amount of interest expense in each interest period until the bond's life is over.